Welcome back to the series that we're learning about introduction to business and how do all businesses function. Today we're going to be talking about security markets and financing investment. Remember, you're taking me either on a fully online class or a face-to-face class, and this is a quick overview to the supplemental material that you've been provided by the instructor, your concept maps or mind maps that you're looking at, the first and second tier, and also by the publisher that has YouTube's videos and other supplementary information to help you learn those things. So this is going to be a real quick overview. I'm going to try to, I always try to keep these under 20 minutes. You could always log into YouTube and just put down financial securities, Dr. George, and look at some of my previous ones that may be sometimes an hour or an hour and a half, depending on my finance class or other classes. So let's talk about security. When we talk about securities, what I want you to remember, securities are basically stocks, bonds, anything I utilize an IOU to either sustain my business, to keep it financially stable, or what do I use to sell some parts of my business or buy some securities from another business as an investment or another stream of income. So let's see about function security. I'm just going to real quickly. So what we covered, we talked about functional security. Let me just make this. Okay, so here's what we covered. Remember, I'm going to try to open them all up like I always do, different classes of bonds. I have a whole concept maps that will be provided that tells you how to read the stock quotations, other information, special bond features. Okay, so let's look about. I'm just going to go. I'm not going to go through all of them. I'm just going to touch on areas that I think you should know, or I know that you will at least be exposed to. So if I'm going to go view, let me go on this one, and I'll go 150. Okay, so now functions of security. Remember, I'm just going to do all of them. That's the basic thing. Is long-term funding for businesses. For lack of better words, is how do I get money in? When I'm looking at securities, I'm looking at debt financing or equity financing. Debt financing means I'm selling IOUs or a type of security. Equity financing means I'm selling stocks or bonds, another part of securities. Okay, so organized security exchanges, you should know NASDAQ, American Exchange, and over-the-counter. I'm not going to go into it. Those are the ones you can look up, and you should be familiar with these terminology. What do you call it? Stock exchanges. You have the New York Stock Exchanges where you're doing all your international transaction. It comes out of the New York Stock Exchange. Just the way it was, anything outside. Inside, you'll have the American Stock Exchange over the counter. I'm sorry. You got NASDAQ, you got London. Remember, every I don't want to say country because the EU is like a block that we've learned before, like the United States. So if I look at the federation, for lack of better words, different rules. So if I'm looking at certain blocks or certain countries, China has their own exchange. Tokyo has their own exchange. European Union, let's see, this one here. Okay, has its own exchange. Okay, now the Job Acts and everything else in here, giving small business jump funding. What you're seeing now with money coming in from the government to stimulate small businesses. Remember, small businesses also, if you're what we learned from other things, if you're a Chapter S corporation, you have ability of selling stocks or giving some way of getting more revenue. The whole thing of this thing is how do I get money, either selling part of my operation or selling part out, or basically buying someone else's as a stream of income. Okay, investment banker, he or she just underwrites it. Common stock. Now here's what you have to look at common stock. Let me look at this at common stock. Common stock, you have voting rights, or you have people buy common stock that they own part of the company. They're kind of like a silent partner, for lack of better words. But they also buy it for an investment as the stock goes up, or they're looking for dividends. So they may look at it as an investment and a stream of income coming in at different times. If I'm buying a house, I could buy a house on investment. I pay $300,000, and in maybe 8 years it's worth $400,000. That's an investment. That's my return on my investment, my yield. Now, that's all. I don't get any money back on it until I sell it or use it, utilize it as a collateral. But I buy this house and I have an in-law, or I have an apartment, or I have I divide the house into my living area or a townhouse, or somebody else's, and I rent out the part. Now I have, the property goes up, but I also have revenue coming in for people who pay renting there. Do you see what I'm talking about? So common stock, mostly common stock. I could buy stock. Remember, you're going to learn about initial public offering. That means the first time a company offers it needs an underwriter. They're offering my stock. Say, hey, here's George's company, GAM Hot Dog. We want you to buy stocks. How do I know he's any good? You have an underwriter basically come in there and says, yes, George has these assets, and I'll certify this. George is good for the stock, and they'll help me set up the stock, set up the payments, how much I should sell the stock. So the initial public offering, when I put it out there, the money comes to the organization. Then you have a secondary market. The secondary market is basically, now I bought the stocks, paid the company, and now after a while I need money, or I want to sell the stocks because I've made some money. I want to sell my home. So now I go into the secondary market. When I go in the secondary market, that's where the market forces how much is a company worth, how much a stockholder's willing to pay. Remember, initial public offering, my underwriter kind of helped me with the value of the company. Now the free market says what's the company worth. George has got the best hot dog, good name recognition, the value of my stock. What I paid, maybe I paid $50 a share. Now it's worth $100 over, let's say 3 years, whatever. So I made value on that. But that's the free market. That's the secondary market. So when I'm selling those stocks on the secondary market, the money comes back into me. Later on, when you take me for finance, you're going to find out a company could issue new stocks. It's not called initial public offering. I don't want to confuse it, but it's similar. It's got a name, right? So now money comes back to me. But when I set up that price for buying more stock, I have to look what the secondary market is. Look at it this way. I bought a house for $100,000, brand new subdivision. I paid the developer. Developer got the money, so okay, I'm very happy. Now, it's your house. 5 years later, I sell the house. The value of the house was worth $200,000. A new developer comes in the area because there's some empty lots there. He's not, or they're not gonna, or she's not gonna sell that thing lower than $200,000 because that's what the value of the house is. If I sell it lower, it's gonna bring the rest of the value of the homes down. Remember, when you get your taxes, when you take me for financing, you find out about taxes, how to do the appraisal. They look at what the value of the homes are going down. What happens when the value of the homes are going down because of the neighborhood's going down, or people aren't buying and investing in it, the prices go down. When the prices go down, the taxes go down. So they have to reevaluate the taxes. So when I'm looking at this, so now I bought the house, the developer's looking at this house in these lots, he or she's going to sell it at that price for that area, not to upset them. But let's see if they're going to come and selling for $300,000, and you can say, man, the economy's not doing good. What do? We could do a stock split. The developer will take that home that's worth $200,000 because the economy's changing, and it's going to convert it into 2 townhomes. So now you still had the values the same for that property. The tax is the same. You just split it with 2 different owners. All right, real quickly. So look at the advantages. Make sure you know the difference between dividends. A preferred stock means I get paid my dividends first. I'm not worried about the value. In business, if I give you something, I want something back. So remember, preferred stock, they basically lose the voting rights. You have all this. 2 types of stocks, right? You've got common stock, preferred stock. I'm not going to talk much. Now, in securities. So you have stocks, that's one security. Now the stepsisters of security is based, or stepbrothers, to be politically correct, is basically bonds. Bonds are IOUs that I can make money on. Bonds also have a primary market, initial market that I get the money, and I can sell bonds on the secondary. If I look, all right, so IOU. I got an IOU from you for $200,000. I need some cash, so I'm going to sell that bond, that IOU, to another person and say, hey, look, he owes me or she owes me $200,000. Okay. What I want you to do is basically, I'll sell you this $200,000 IOU from George for $175,000. So now I'm getting a discount, but I need the money now. And I'm looking at when people sell the bonds or out there, they're looking if I have to go out and get more money. I have to go to a bank, and they're going to charge me 7%. If I could sell my bonds at that lower amount, because I already own it, and make some money, and it'll be less than me taking out a loan. You see, so when you take me for finance, you have to look at what am I doing? I'm moving this over here. I'm making money here. That's what the securities. Now, securities are basically instrument that has money, that has either IOUs, bonds, or stocks that I use to operate my business. You have a checking account, you have a savings account, you have investments in your home. We'll find that out later on, okay? So now you talk about bonds, okay? It's basically debt financing. Remember, when they talk about equity financing stocks or selling something, when they talk about debt financing, they're talking about IOUs. Remember, whether you like this administration or not, President Trump is trying to move the economy out of a debt focus into an equity focus. Is it working? Yeah. Who knows? We'll know. From a business perspective, all I'm going to know, here's the direction the forces are leading me. In this case, would be the administration. How do I adjust to maximize the highest return of my investment? That's the whole thing, okay? All right, so you've got that, types of bonds. I'm going to talk about corporate municipal. U.S. Treasury bonds are the best. They don't pay a real high return, but they're the safest. All these other ones are the charts of various bonds. And I got the chart here. And it basically has information. Remember, I'm going to just open these up for you so you look at it, but I'm not going to go into them. You look at it, read the book. This is something else. Special bond features. You have a sinking fund. That means I put money away to pay it. Callable bonds. I could say, hey, here's the IOU. You got it for 16%, and now the interest rates drop down to almost, I think, 4%. If I'm looking at in European countries in a negative, just be familiar, all right? So it dropped down. I don't want to pay that now. If I'm owning the 16%, I'm going to sell it to somebody else because the interest rate is 4%, but I got an IOU for 16%. And I'm going to sell it to somebody else for 15%, and they get the money. You see how you're making? I'm making money. I'm selling the secondary market. The callable option allows me to say, hey, forget that. Don't sell that. I want that bond back. You could have the new bond for 4. I had that option. Here's your money. And then we just close it. So the terms and conditions are what you're going to find out in finance, okay? 5 credit, and we learned about this. You got investment risk, yield, duration, liquidity, how quickly it could turn anything into cash. And the most liquid asset that you found out is cash or debit, right? And then basically you have your mortgage is not a quick asset. You got to sell something or anything else, okay? Okay, tax concepts, buying securities, you a stockbroker, or there's like E-Trade, American. There's a lot of different services. There's a lot of your insurance company. I'm with USSA. It's the United States. It's a military insurance thing, but they also allow me to invest utilizing their structure or their tools. Because they figure it's all bond, and I'm not going to go someplace else because I get my investment. You still got to make the decision. You got to do research. If you're paying a broker, you're assuming he or she's doing all the research, and you're paying them a fee. Okay, diversification. Make sure you buy in different things. You buy in bonds. You buy from Motorola. You buy from Abbott. You buy from an environmentalist. Whatever. Okay, primary investment services. Okay, help with 401. We talked about, and he also did a good job. Perception of the market. Okay, now here's what you want to look. When you look in the bull market, and everything's going, are we in a bull market? No, we're basically in a bear market. Everything's sleeping because of the COVID-19, whatever's happening. The market is quiet. But that bear, what they talk about a V up there, there's a lot of people. Remember, the market, when it was shut down, it was shut down by the administration in a timely manner and controlled. It wasn't like external forces because of recession, inflation, a war, something that shut down the market. This was shut down by the government. So when it all opens up and say, okay, it's open up now because whatever issue went away, now you will have that spike. People had the money, they couldn't do nothing, and so they have the V coming up. Interesting. Follow along if those of you are in finance, okay? Selecting the stock. Okay, you got gains. Remember, do you want for growth? Do I buy a house for growth? Or do I buy it for revenue? Or do I look at both? Now, the blue chip stocks are basically the 50... the best company, the most sounded or secure. There's no company secure. Anything could happen, right? But and pennies under $2. So if I'm investing, blue chip, secure, out there, established, up to this point. The thing you have to look at, what's going on, is people go, I'm going to invest in Google. I'm going to invest in Amazon and Facebook. What's happening? The government's looking at, are they too big? Are they a monopoly? Are they going to split them up? So as a shareholder, I may be selling some of those stocks, but I'm hoping that people are going to come up and buy them because I want to get out of there before something happens and they split it up and all of a sudden the prices drop. When the prices drop, that's when I want to buy stock. When I think they're going to drop, that's when I want to sell it and maximize it. Okay? But now, you're going to pay big money for it. Now what you're looking at, the penny stock. These are little stocks that basically need, there's a startup company. You research something. Oh man, this could be something that could help going forward. I see a potential in it. So I spend a little money on that. As the stock goes, marijuana stock, like I'm not trying to say, my son was picking up some marijuana stock, I love it, he's all going to go in the store, blah, blah. He was buying it real inexpensive. Now as more states are opening up and legalizing marijuana, not only for medical use, but also for recreational use, that stock went, same thing with Bitcoin. You wish you would have bought it that time, but now, once it hits a plateau and more investors coming in, because the stock market goes similar to like a business cycle that we've learned. Once it hits that plateau and investors, now the prices are going to come back because there's more option, more people are selling it, so now competition will bring the price down. You have to know when to get rid of it. All right, but I bought it. Do I keep it, or I made my investment and find another penny stock? You're taking a gamble. When you invest in a stock, you're taking a gamble. It's kind of like a gamble. So when you put the money away, you want money to, you want to get something back. Put the money away that if you lose it, it's not going to hurt you. You're not playing the stock market. You're looking for long term. Okay? Same thing when people buy a house. I buy it this year and sell it. You're never going to make no money that way. Your points and everything else. Same thing with stocks. You got to wait for the yield, but you got to look at the timing. So you're always watching. You're looking at the thing. Remember, it's not that hard to follow the stock market. You've got maybe 20 stocks. I'm just giving that. And you're looking at those stocks, you got them in Google Finance or something, and it's sending you data, and you're looking how many are selling, what's going on, you hear in the news, and you're monitoring it, and you say, okay, do I get out of here? Do I do this? How do I max out? That is what a chief financial officer does that we talked about last time. This is what a lot of people do now. Okay, we talked a little bit about stock splits, buying stocks on margin. Basically, it's like an IOU. I said, hey, I got some collateral. I'll buy the stocks on margin. Take me for fine. I want to do it. You don't have to put down. Look at buying stocks on margin when you buy a home. Could we buy a home in this area, in the Lake County area or in the Cook County area, those two areas, for $350,000? No, you can't afford that. So what do? I put a down payment down on a car that's on margin, and then basically it's a little more complicated. I'm trying to simplify it. Do you see what I'm talking about? So I'm only putting a certain down, and then basically I could buy that share, and in that time I'm buying share, I'm stocking, so I could sell it. Remember, I bought it on a margin, so I only paid a little amount to have access to this stock, so I could sell it on the market back and forth, and then when it's due to pay out, I had to give them the money back. Hopefully by that time I sold it and made some money on that, and I'm using a little money to get a bigger investment. That's what you do now. I put my down payment. I get a loan on a house, 350, maybe put down 100,000, so 200,000. I keep it for 5 years. It went up double the amount, and I sell it. So do you see how I'm looking? The money I put down is my investment, my seed. They always talk about seed, and then when I'm selling, I'm looking at the yield. And the yield in stock means everybody that wants some money, the tax of the government, geez, investor, these fees, this closing fee, these open fee, all these fees after I paid, how much money do I have left? That's my investment. That's my return on investment. Okay, types of securities, real quickly. It's a little primary market, secondary, we talked about it, stock quote. Okay, now I have a whole chart on here, Microsoft quotes, high-low. This is what you're looking at, your price change, year-to-date prices, high-low prices. And remember, you're looking at last time, so you see what's going on with the price. And price is a good indicator. Not everything else, because a lot of people can manipulate with the price by selling a lot, and the price goes down, and boom. And then, so you get rid of it because you think something's going on in the market, and someone's manipulating because you own a lot. The government kind of controls that. Okay, financial news research, I'm not going to talk about that. These are just some finance, daily finance, MSN Money, Forbes, Dow Jones averages, okay? Understand quotations. I got a chart here. Tells you a little bit about that. I got mutual funds. If you're not sure about mutual fund, you basically pay someone that's going to basically diversify, and he or she's a fund manager, or a corporation, a fund manager, and you get a return. You don't control it, but it's kind of nice because you see how you see what stocks the mutual fund had, how they diversify, what percentage they have risky. What you're not going to be over risk. You're not going to be made rich, because it minimizes the risk. You got high risk stock, you got low risk stock, you've got stocks that are constant, and you put it all together, you get an average, and you get a return. But it's a good way of learning and watching how they're doing it, and then you can spin off on your own. You're not making money, but it's a good way to start it off, okay? Quotations, I have that brokerage, right? The fee, investments, okay, warning signs, measures of investments, okay? I'm just giving you all this information, opening up. Okay, cleaning up the street. All right, if you look at all this stuff in here, remember everything I'm telling you now, the book is about a year or 2 years behind. President Trump's changed a lot, so the economy is doing some twisting. I enjoy this, follow it. But this is all outdated. It doesn't make a difference. You have to understand the basics. Once you understand all this, then you see what's going on, and now that's how you learn. Remember, this class that you're learning here is just new vocab. Look at the vocab. Look at everything else you're learning. And I think I have this one level. So we covered everything on here. For lack of better words, view. I just want to leave you the last thing. Good map. Okay, so this is it. Again, let's see how long. This one went a little bit longer. I apologize, but finance is no way. Remember, just more in the book, more in the reading. This is just a quick overview so you understand a little bit about securities. Take me for finance or any instructor at a community college. A lot of them, they have a good background. They come from the corporate world or from a small business environment. I'm not. You still have to do, how do I get revenue coming in? Remember, either debt financing, I take an IOU, take a loan out, or I do equity. I bring in shareholders. That's why the structure of the company makes a big difference. LLC, S corporations, different ways of bringing in clients and bringing in revenue into your business. All right, so let's see now. Recording. 23 minutes. This is probably my longest one, but it's better than I thought. All right. So again, thank you. And I think the next one coming up out of here would be we're talking about the banking. That's going to be an interesting one. A little spin on that one. So make sure you look at that one. And then later on, we're just going to talk a little bit about personal finance. All right, again, my name is Dr. George Machaki, and I hope you enjoyed this video. If you don't get a chance to take me for any classes, take some other instructors at a community college. You get your money's worth. You have a lot of people who have the experience. They just don't want all the... they like just teaching to the everyday individual. Have a nice day.